We're going to spend today 1 hour and a half. It's a very difficult exercise because basically we don't know each other. Usually when you get a class, basically after a couple months we get to know each other, you know, how I work and how you guys are working, which is not possible today. So it's going to be like a blind date, maybe fast. I'm head of macro, so I don't know whether it's something that resonates with you or not, but that basically means that on a daily basis, my job boils down to trying to understand economic dynamics, what's happening in the economy, and to try to use that to create strategies, to have views, to navigate our portfolios through what's happening on the macro front. It can be the pandemic, it can be what Jerome Powell is saying when it comes to the Fed's monetary policy. It can be recession, it can be I don't know, the Brexit votes, this kind of thing needs at some point some macro input, and that basically what I've been hired for at Lombard Odier Investment Managers, which is a different entity from Lombard Odier Wealth Management. We don't manage the portfolio of individuals, of private individuals. We manage the portfolios of pension funds. So we have what's called institutional clients. If you live and work in Switzerland, maybe you know of that. Eventually, you will have what's called here a second pilier, so basically a portfolio with your name on it that will be invested in markets, in solutions such as the one we offer to our clients at Lombard Odier. Past this point of the speech, anything I'm saying is not the reflection of the opinion of my company or any of my previous employers. That's a disclaimer for today. So basically, when I was offered the opportunity to spend this moment with you guys, I scratched my mind, like, what could I be talking about? And basically, without surprise, I'm going to talk about markets and economy and the economy, which is why we have this title, macro versus markets. But the entry point will be something a bit different from maybe what you guys are used to. Okay, the entry point will be something that I'm hearing more and more around me in different places where portfolios are getting managed, which is that to some extent you need to take a risk to be rewarded. You need to take risk to be successful in your portfolios. Okay, and that's an idea that is widespread now. And well, I'll try to make a tour of different things you've heard of different theory, of different models you've been introduced to, and trying to explain, like, what does it mean, like taking a risk? Is it really what rewards you, or is it something else? And my eyes are turned around the first word of the presentation, which is usually the most important. So risk is something that we're all used to. And before I dig into the deck of slides, so first of all, we've all learned to live with risk over the past 2 years. I think it's quite clear that risk is a situation that we are all familiar with now, and not only portfolio manager, not only I mean, somebody administrating, I don't know, vaccine, for example, to somebody. Risk is everywhere. Okay, that's something that now we are well aware of, and that's something that's hitting our lives like full blown. Now, there is something about risk, which is a feeling that we all have, and I would like you to relate to that feeling. There are all points in our lives when we put a lot of energy into something, okay, and we take a risk. And we get rewarded for that. Okay, it can be anything. It can be you taking an exam, like you prepare yourself for the exam. You take the exam. It's a risk, right? The risk that you will fail, and you succeed, and that feeling is amazing. It can be the risk of opening up to somebody. It can be the risk of personal stuff, which makes that eventually, when you're rewarded, you get this very nice feeling in your chest, and you're very happy like that. Okay, now. This idea is well entrenched within our societies because basically Protestantism puts forward the idea that if you take risk, you will be eventually rewarded because it's a way to know whether or not you've been chosen. This kind of a philosophical question. Where I'm heading to is this idea has been translated into financial markets to some extent, in the sense that if you take risk in markets, you buy a very risky stock, you will be rewarded. You've been buying Bitcoin in 2013. Right? You bought 10 Bitcoin and you've been well rewarded. Okay. Today you've earned a lot of money. Okay. Have you been rewarded because you've been taking risk? Okay. Is it right that you can have that basically you should be rewarded once you're taking risk? I think that analogy is a terrible analogy. It's the worst analogy you can think of. And the reason for that is because it gives you the idea that, oopsie, that financial, oh la la, that financial markets, not me. Slide, I don't know what's happening with the mouse, but I'd like to. It has been a zoom. I can start touching that. So the idea is that basically, bear with me, I'm sorry. The idea is simply that, well, basically when you look at markets, it looks like casinos, right? You're always under the impression that you're buying things and it's a bit random, and depending on your luck, you can actually be making money or not, right? It's a terrible analogy. That's not working at all like that. And I really would like you to share with you a couple of thoughts on those slides to try to convince you that if you think of it like that, then basically you're missing the point. I think the mouse is broken now. Right, pick his mouse.
Maybe if you unplug the mouse and you can just press the keyboard to the next slide.
Yeah, but I don't know.
Ah, ça rebouche. Elle est bon?
Oui.
Ah, magnifique. Voilà. What happens on the daily so basically, I mean, the idea, what I was going to try to introduce as an idea is that market look like casino. Basically, you have a bunch of different. Maybe it's me.
Yeah, it's understandable.
Et sur l'écran, Okay, sorry for that. I'm gonna move forward with a very lousy introduction. But when you look at here, what you have is the performance. Basically, you buy $100 in 2006, and you invest that in different types of assets. Can be bonds, can be equities, emerging or developed, different types of credit bonds, high yield, investment grade, commodities, or you're simply buying the US dollar. Okay, and your fate is very different in how much is that? 15 years. In 15 years' time, basically, you wouldn't have one exactly the same thing. You have two different types of trajectories. You have, of course, trajectories that you get positive, basically equities, or negative, commodities. You have trajectories that are very smooth, just like bonds here, or you have strategies that are very volatile, You have assets or types of assets which are very volatile, and you see massive swings, ups and downs. The 08 crisis, 2015 Chinese crisis, the 2020 dip from the coronavirus recession crisis, and well, basically it looks like casino. You place like some of your money on one number, and then you wait 15 years, and then you wait to see whether you've been making money or not, right? And that's not nothing but an impression. I'm gonna try to. So first of all, that is just my opinion. Okay, it is substantiated by different elements, notably things that you've been introduced to. We are going to talk about CAPM. We're going to talk about the Gordon and Shapiro model. Maybe that's something that rings a bell or not. If not, well, basically today's a premiere. But my opinion is that there are two ways of seeing markets. The first way is through the lens of what I will call the risk premia theory, right? Okay, you're taking a risk, you're exposing yourself, therefore you should be rewarded. Okay, we're going to work a little bit around that idea. And the second idea is the macrofinance theory. So basically, maybe there is something else that rewards risk. Okay, but maybe. Okay? And it's just opinions I'm going to share with you today, gathered from different elements. The first thing is risk premia theory. So what is this risk premia theory about? Basically, that's exactly what you have in front of you. Investors should be rewarded for holding risk. Okay, and that became a very dominant way of thinking of financial markets. Okay, I'm not saying it's wrong. I'm saying it has shortcomings that gives you the impression that you're gambling on markets. Okay, that's speculation. So basically, buying something or selling something to profit from its rise or its decrease, because of its price. That is bad. And actually, it's not. Basically, it's you providing money to the financial to the lung basically of the economy. But I'll come down to that in a couple of minutes. So basically, there are three different elements that you can take from this reward for holding risk. The first one is riskier investments should be rewarded more. Okay, if you have the choice between A and B, and A is riskier than B, go for A because A will eventually give you more money. Okay, you have the choice between I don't know, Tesla and something more commoditized. I don't know, as you see, Total, for example, but Pfizer, for example, to some extent has lower risk than Tesla to some extent. Okay, because the business model is not the same. One is basically a car you're making, and the other one is full of innovation. So you never know what could be happening, right, with Tesla. So go for Tesla because Tesla is riskier. That's basically what it says. Second element is that buying the riskiest stuff is not enough. You can always borrow money to buy more of the riskiest stuff. It's called leveraging yourself. So you're borrowing money, okay, to increase your exposure to markets. That has become very commonplace in the way funds are managed today. It's called a leveraging fund, and it's regulated, of course. But the standard asset allocation fund has a leverage of 2.5 times, or 250% of your money. You give me 100, and I manage your 100 as if you would have 250. Okay, and I can do that with derivatives. I don't even need to borrow money, and it's not a Ponzi scheme. It's not bad. Okay, it's just a mean to obtain higher returns. And the last element, of course, is the founding pillar is the efficient market hypothesis. Markets are, by essence, unpredictable. You cannot predict market. If you can't predict market, basically go for the riskiest of your assets and hold it for long. Right? That's basically the bottom line of it. So, does it work? What you have on page 6 is just a snapshot of that. You have the returns per year, annualized return, 2014, 2021, and the volatility associated. Okay, I hope that you're familiar with the concept of volatility and the annualized returns. I've picked names to try to attract your attention because maybe you're consumers of these brands, such as Netflix, Apple, Facebook, and Amazon. And as you can see, they have a volatility of about 30%. They have a return per year of about 35% on average, with Netflix being at 55% since 2015, not bad. And of course, when you compare that to the equity index in which they are, which is the S&P 500, of course, the volatility of the S&P is lower, and therefore its return is lower than the rest of them. So you went for the riskiest element in your portfolio, and you've been outperforming constantly something less risky, right? That works. I chase the risk and the risk reward, and the god of risk reward in me. And last but not least, the riskiest of the stocks, which is Netflix, has really been having the highest profitability in your investment, 55% per year. For God's sake, that's huge, right? What does it mean? Just like if you're not completely familiar with measuring risks, I've just put together this chart, which is completely stupid, but you see the S&P, right? You see the year-over-year performance, the black line, and the red line is the same thing with Netflix. So the black line is on this scale. It goes from minus 10% to 40%, and the red line, which is Netflix, goes from minus 20 to 85%, okay? So that's risk. Either you go from minus 10 to 40, or your portfolio goes from minus 20 to 85. So it's a very big difference in terms of risk. You're taking twice as much risk as you would be taking in the case of the S&P. Now, I can find stocks for which it hasn't been working also. So first stocks that say basically, no, maybe that theory is wrong, and that's basically two different cases. The first one is Pfizer. And we hear a lot like pharmaceutical companies have been profiting a lot from the pandemic and stuff. And look at that performance. Who has been profiting the most? I mean, assuming that there is a connection between the wealth of the company and the valuation of its stocks. But if Pfizer delivered an 11% performance, so underperforming largely the index in which you will find it, the S&P 500, basically, it did so for a volatility which is 25%, not that far away from the FANGs. So it's a 40% difference in terms of performance per year on Netflix across the past 2014, 2021, 7 years. That's very massive, right? Total is not the sum of everything, but is the oil company. Okay, the oil company. I mean, oil hasn't been faring quite well over the period. For many reasons, inclusive of the pandemic, the slowdown in China, and more recently on the measures we are taking to change the way of life that we have to consume less of carbon products. So it has had a performance of 6% per year. I'm sure that even with bonds you can do better. So that's the first step back in this theory. Basically, if you think that the riskiest of your position will be delivering the highest of the performance that you can have, basically, at least the door is open, basically, to say maybe not. The thing is that this idea of risk premia has been working as a contagion, so it's been impacting all the way of the other places. Initially, it started with stocks, and progressively, it's been invading the whole investment industry, notably like with this idea that equities should outperform bonds over the longer run, as bonds are less risky. Okay, if you're buying a bond, the bond basically is if the company goes bust, okay, the bondholder get the money first. Okay, and then if there is some money that remains, that goes to the equity holder. Okay, so naturally, stocks will be riskier than bonds by construction. And then if you take bonds from the German government or the Swiss Confederation, of course, the risk is very minimal, because if they go bust, basically, at the end of the world. So equities, more risky, they should outperform bonds over the longer run. Commodities, very risky. On average, commodities is twice as risky as equities. So you should expect twice as much performance. Not the case, as you'll see. Liquid alternatives, illiquid products is something that has been also ramping up. Risk is not only a volatility, but it can be something else. I'm gonna go through a couple more slides before making a pause, so that just to see if you guys have questions or things you would like to ask, and also from the other campuses. Okay? But Again, does it work? That chart just compares the performance of the MSCI World, which is one of the largest index of stocks. Okay, MSCI is putting together representative indices of the stock market, and that's this big red line here, which has been going from 100 in 1989 and to 1,000 recently. And next to that, you see the Bloomberg Government Bond Index. So basically, if you were to be offered, if you had the opportunity to be either buying bonds or buying equities, if you went for the riskiest of the two, you would have earned money. If you don't trust me, I've charted here the evolution of the volatility of equities versus that of bonds. The ratio of the two is incomparable. One is around 3%, and the other one is around 15%. It's a very big difference in terms of the active risk that you're really taking. Okay. Bon. There are a few elements that you need to be aware of that contradict this theory of the riskiest position, your position, and the higher the PM. The first one is the fact that first, there is time variation in the reward. Okay. If I go back to the chart, if we would have been in, let's say, 2013, okay, right here, in 2013, we would be here, and you could be saying, well, basically the riskiest of all investment, equities, is below the black line, which means that bonds have been outperforming. Okay, there is time variation, and I don't know if you can see it from where you are, but basically this time variation happens in 2001, in 2008, in 2015, and in 2020. Okay, so there is something that seems to be relating this decline in the profitability to something that happens in 2008, in 2001, in 2015, and in 2020. I'm not saying it's the economic cycle, I'm just saying there is something that seems to be coming and going, okay? That's the first element. The second element is there are risks, there are securities, there are investment vehicles, there are strategies that have been delivering a performance which is zero or very negative. I'll give you a couple of examples, but you see that it's not because you've been chasing the highest of all the risks that you get the highest of all rewards, at least historically. And finally, there is something, I mean, I've been working for a company called Unigestion, and at Unigestion, Unigestion is a specialist of the level anomaly. In equities, when you're buying the least volatile stocks and selling the most volatile stocks, over the longer run, you're delivering a performance. And that's called the level anomaly. It's something well studied since 1997 from the back of my mind, but that's something very fun. I want to show you a couple of examples, and then I'll make a pause, okay? Before we go anything, I mean, deep down, I'm a quant. So basically, I do a lot of programming, and not as much as some people in my team, of course, but I do some programming, and something that I've always thought of is how much risk shall I be putting on the table? Okay, so assume that in January 2020 you have $1 or €1, €1, whatever you want to invest. Okay, right? And you invest that money in the S&P. It's not written on the chart. Terrible job. You invest your money in the S&P. Okay, and you have the choice. I give you the choice to invest 1 time your money, twice your money, 3 times your money, 4 times your money, freely. Okay, up to 9 times your money. Okay. So basically, if the S&P does 10%, 9 times, you'll get 90%. You'll do a hold up, and you will be able to nag your friends that made their money out of bitcoins. Blue line here is just 1 time the performance, and you see that as you're increasing your risk exposure, this is called leverage. That's the leverage I was referring to at the beginning of the performance of the presentation. You see that with 9 times, basically. Not only are you losing a lot of money, okay, but you will never recover. It's not because you have 9 times the exposure. When you're using 9 times when you're losing most of your money, it will take an awful lot of time to be able to recover everything. So basically, after that period, after the crunch coming from the COVID crisis, having the highest risk exposure was not the ideal situation, and we've had quite a rally. We've had one of the most amazing rally. Look at the chart I was showing before. That's the COVID recovery in terms of equities. Never since 1989 have we seen such a performance in market from the bottom to the peak. Okay. We don't know yet whether we've reached the peak or not. Okay. So when you do quant strategies, it's a thing that you know a lot. When you're wrong, when you're losing 10%, it will take 20% to go back to where you were before the loss. Okay. So it takes twice as much to recover as you've lost on the way down. Okay. So mastering that leverage parameter is a first element. Second element, when I was your age, when I was your age, something was very trendy: investing in commodities. Pension funds were very keen on finding sources of diversification, and historically, oil, gold, copper, agricultural products were very trendy because they had a very low correlation over the past 2-3 years with stocks. So they were a source of diversification, and they had a positive return, okay, over that period. So that's more or less the moment when some people in the industry started pitching their clients, you should be including some commodities in your portfolio because it's a very interesting opportunity, at least I think. And right after that, the price of oil went up to $120, $130 per barrel on the back that China had an extraordinary economic growth, and we were living in a very different world, a world of very expensive oil. Well, since that moment, all that we've seen is basically a downtrend. And if you remember well, last year, we've even seen negative prices for oil. Remember that? Reflective simply of the fact that the storage cost was so big that you will need to pay somebody. Whatever. Again, commodities as a whole have a volatility of 40%, twice as much as stocks, okay? Twice as much as stocks. And they've been delivering a very negative return over that period, okay? Right? What I find interesting is that they've lost in value in 2008, they've lost in value in 2015, and they've lost in value in 2020. Just saying. Normally, one of your teachers should have showed you what's an efficient frontier. So basically, it's a chart that compares. Here is volatility, and here is returns. Okay. So basically, it says that if you have a target performance of 5%, right? You have the choice between investment grade bonds with 5% volatility or DM equities with 17% volatility. Okay, that's how you read that kind of chart. Maybe you've seen something like that in your classes. Okay, so if I was to hide the last part of this graph and just look at that, well, as I'm adding a risk, I'm increasing the returns, realized return. Okay, you move from 4%, sub 4% to 7% for high yield bonds. Okay, but now not only commodities with negative returns and high risk are here, but also DM equities are not in line with government bonds. EM equities are not in line with government bonds. And some companies are actually actively exploiting that. If you would have had on that period the choice between holding credit bonds and equities, or bonds globally and equities, you should have went for bonds. Okay? Because for the risk you're taking, you're getting the same return. Okay? So it's not just an anomaly. Now, that's an homage to somebody that we know. There is another thing that is very well known in the equity industry. So, maybe you've been introduced to the CAPM model, the Fama French approach, the APT. Maybe that's our names. You can decompose the risk of a company into different factors: portfolio model, value, and size. Which brings an event. Whatever. One of the equity driving force that has been found out in the late 90s is called the low vol anomaly. If you look at, for example, global markets here, okay, the red line, the green line here shows what happens when you're buying, okay, so 25% least volatile stocks, and in red, the 25% most volatile stocks. Okay, And you can see that the fate of both strategies is not the same. It's not because you've been buying the most volatile stocks that in the end you get the biggest reward, and actually quite the opposite. And the reason for that is because basically when things are going down, are going bust, and especially during the 01 dot-com bubble and the great financial crisis, you're not losing as much as the others. So you've been able to create some called that's called the asymmetry of a strategy. You don't lose too much when you're losing. You don't lose as much as the others when you're losing, which makes that you're preserving capital, and it's very trendy in the industry. Anyway, and it's not just global. No, it's just global. It is global, meaning that it works for Japan, for Europe, for US. It doesn't work so well for emerging markets, but I mean, everything is volatile in emerging markets, let's face it. And it works a little bit also in Pan-Asia. So it's something really regular. So there are companies that have built like a large fame on the fact that they've been pushing products where you sell the most volatile and buy the least volatile equities. Exactly the opposite as what the theory of risk premia predicts. You're going for the lowest level of risk, and yet you're performing, you're delivering some returns. Okay, it's called an anomaly. Well, it's a persisting anomaly because even as of today, it's been working quite well. I think I reached. Oh no! Oh. Funniest of all story. I think we find our pleasure where we can. So you can't see anything on that chart. The only thing that you can see that there's something that goes up and then that collapses to zero. Okay, it's called the XIV. I don't want to say something wrong, but from what I remember, it's a Credit Suisse fund. But I mean, there were also funds like that. Do you know what the VIX is? The VIX. The VIX. It's a volatility index. Yeah. Okay. It's an implied volatility index. It's basically if you can extract the implied volatility for options, and that gives you an idea of how big is the demand for hedging to some extent. Okay, but actually you can create a strategy around that and buy the index, and there are futures on the VIX and stuff, and you can create a strategy around that. Okay, but buying VIX has a big cost for some reason. There is a carry component basically. There is a thing that when you're buying VIX, you're bleeding a lot on a daily basis because it's basically you're buying an insurance contract. Okay? If equities goes down, the VIX will go up. So you're insuring yourself, you're protecting yourself against a drawdown in equities. And as you know, when you're buying yourself protection, basically it's expensive. So some people came up with this superb idea of selling protection. If you're losing money, if buying it means that you're losing money on a continuous basis, why not selling it? Because if you're selling it, basically you will be making money every day. And that's the beauty of it. From 2016 until 2017, until the last day of January, actually 2018, this strategy has been trending up, delivering a massive amount of performance. Because basically it goes from, say, 0.2 to 1 point something. It's 5 times the initial investment in only 2 years. Okay? Well, very big risk, very big volatility. In the end, minus 100% return. In one day, basically, the VIX exploded, the VIX increased rapidly, okay? And you were selling it. And you were selling it so hard that when it reached levels that were so big that basically the money went to zero. It's exactly the same situation as here. Basically, you've been losing all your money and you will never recover. And it's not because people have left the fund. It's because the money is gone, okay? All the money is gone. So again, big risk, low vol. I mean, it's a bit overwhelming now that I'm doing it live as a list of examples, but the idea is just to help you understand like this theory of more risk, more return. Does it make sense? Should I really be rewarded? I mean, I'm sure you have friends that have been buying cryptocurrencies and that have been saying, I bought like, I don't know, Ethereum or Bitcoin or anything like that 3 years ago, and today they are crazy rich if they with a pinch of salt, if they've been able to materialize their gains. Okay, there is a way around that thing. Okay, I'm not saying it's all wrong. I'm just saying that it lacks a little bit of economic structure around it, and I'm sure that you already know models that we can use to try to show you that you're already economists and you already know exactly what's going to happen if the economy goes wrong, given all the models you know. Before that, I'm going to make a short pause here. If you guys want to ask any question at some point, now is the moment. Some familiar names. Established.
You have one question.
Sorry.
Sir, so I would like to ask a question about leverages.
I'm going to get new girls from here.
So I would like to ask a question about leverages.
Okay.
So you said that when you take a leverage, you kind of borrow money in order to increase your return, your rewards.
Mm-hmm.
So does it mean that you increase also the risk to lose money, like to lose more money that you invested?
Yes.
So like if
One
you
to
might
one.
give an example. So for example, you invested like 100, and then with the leverage you get like, let's say 1,000 to invest. So let's imagine that you lose everything. Do you like owe money to the market after you lose everything, or it's just all your money that you lose?
It's a good question. It's something very interesting actually. So the idea is when you're leveraging yourself, it's as if you are borrowing money, but you're not really borrowing money. It's just that when you buy something like a future, okay, which is a derivative, there is a counterparty chamber that asks you to lay down a deposit, and that deposit is not 100% of the value of the future. It's going to be a portion, something that will absorb the first variation of the price equation of the future. If things go south and the trade doesn't go too well, basically that deposit will be absorbed, and then the chamber will call your bank and ask that you either put some more money in the trade so that you will be facing all the margin calls. If you know the movie, that's exactly what it was about. Or not, and if it's not the case, if you don't have any more money, the trade is ended, and you take your loss, and that's the end of it, and everything is very neat.
So you don't have to. So it's not like you owe money to the.
No, it's not forming a debt. It's not forming a debt on your bank. No.
And I have another one of questions. You said at the beginning that there is no way to predict the market, but if there is really like no way to predict the market, how do portfolio managers like ensure their clients to make benefits?
There are many ways to answer that question.
Because I've heard about like technical analysis, fundamental analysis, for that to analyze the market and like kind of make sure you can either win or lose. So relevant.
I think you've been introduced to the efficient market regularities, which say that basically every public information should be in the price of assets instantaneously the moment they are released. Right? That means that if the CIO steps down, the moment it's announced, that will be implemented, that will be integrated in the price of the stock and the market. That hypothesis seems to be saying, well, basically, there is no way to predict the market. Okay. So some people have developed strategies that are not based on views, meaning you don't need to assume that you know where the market is going, but you're just playing on diversification. The team I'm working with, for example, we do a different version of what's called the ERC, equal risk contribution portfolios. Basically, it's a very fancy word to say that we try to have as much risk in bonds as in equities, as in credit, as in commodities. Okay? And in order to create a diversification, so a way to diversify. If we're wrong holding something, then we'll be right on holding something else, and things will offset each other. That's basically the essence of diversification. My take is that also if you're good at predicting some things that makes a market move, then basically you can try and predict the market, but it's a difficult art. And there is an extensive literature on Professor Scaillet at Geneva, the Geneva University, for example. He has a well-known paper that shows that among our active managers, so portfolio managers with a view, okay, with an active view, I think that the 90% of people were actually lucky, meaning lucky means you can generate some performance, but that performance is not regular enough. 1 year you win, 1 year you lose, 1 year you win, 1 year you lose. Okay, and if this developed a very interesting test, and it's crunched a lot of numbers with a lot of funds, and the conclusion was 90%, I think, or 95%, it was very big, of the portfolio managers are actually just lucky. They don't have any skill sets. They're just lucky, which does not help in this gambling thing. So that went in the Financial Times. I'm sure he got tons of email of insults.
Could you repeat that? The professor's name?
Come again?
Sorry, over here. You mentioned the professor at the university.
Olivier Scaillet, Scaiet. He's been sharing the finance program at Geneva. And is very interesting. And I think I have a question here. Yes, how the stakeholders will evaluate. So, yeah. Scaillet, Scaiet. I wouldn't try. If somebody can spell it in the chat, yeah, Scaiet on the Geneva place. I think it's well known. Just to answer the David, thank you, David. so many familiar faces. How the stakeholders will evaluate the level of risk they can take? Isn't the abstract formula for risk evaluation or only different version? That's why it's a very good question, Marzia. Basically, it's actually an even more important question for wealth management, for example, where you first need to define how much risk you can bear, actually. Because bearing risk means that this risk-bearing parameter is a very important issue because it's a way to manage your expectations. If you're expecting, you need to realize when you're saying I want to take 20% volatility in my portfolio that basically you can lose 40% in a year's time, and that parameter is very difficult to evaluate. There are plenty of literature on the topic, and it also depends on the level of your wealth. Usually, what's found out, that maybe I'm wrong from the back of my mind, that the wealthiest you get, the more risk, the higher the risk appetite you have. Because you can lose, in nominal terms, more than somebody with a lower level of wealth. Do you see a risk of single temporary? So, Rafael, it's a good question, but I think it's a bit beyond this class. And the answer to the question is not really, but rising real rates is currently the topic of the moment. The small column on that topic you can find on Google on the website of London. So if you don't mind, given the time is fine, unless you guys have another question. Okay, I'm just going to, so. We are entering into the second portion of the presentation. Okay, the idea was just to start by saying, all risk is probably not the best idea, and the question is not, shall I expose myself to risk, but more to which risk shall I be exposed? So there is a question of quality of the risk to which you could be exposed, and that's basically, I think, one of the hidden ambition of this macrofinance theory. I'm gonna try to describe or to introduce you to now. On page 19, if you're following from somewhere else. That, I think, is the model, the most common model shown in the finance class. That's called the CAPM. And I'm expecting that maybe you have some degree of familiarity with this animal. And if not, I'm going to behave as if you don't. Meaning that basically that equation says that the risk on one stock I at time t, the return, on stock I at time t can be decomposed into two big elements. Okay. One element called the idiosyncratic risk, which is this epsilon I, which is basically shocks that are very specific to the company. Okay, something that is related to the fate of the company. Pfizer puts together the first vaccine against the COVID. Basically, the stocks goes up like crazy in the space of I don't know 10 minutes. If one day you can see the chart of that, it's really fantastic to see at which speed information can be incorporated in the price of assets. But that's something very specific to Pfizer. Okay. That's idiosyncratic risk. Usually it's epsilon I. Basically, it means whatever is not explained by this big beast here, which is a systematic risk. A systematic risk is basically the risk that ties to one factor, which is the market portfolio. Okay. So basically, you take your Pfizer stock, okay, and you try to decompose its performance between two elements. Okay, something that is related to the fate of the company that any student of corporate finance should know of, and something that mimics the evolution of the market. Okay, let me just roll back rapidly. No, here. Netflix, S&P. Let's disregard the beginning of the history and let's look at what's happening after. When the S&P goes up, Netflix goes up. When the S&P goes down, Netflix goes down. Okay, there is a relationship between the two that seem to be co-evolving together. Okay, that's called idiosyncratic risk. What's funny is when you look at the beta, which is this Greek character here, which measures how many times Pfizer replicates the variation, the performance of the market portfolio. That's basically the S&P, okay? That's the return of the S&P, and that's the return of one of the stock in the S&P, okay? And the beta gauges how many times, when the market does 10% up, does Pfizer do also 10% or 8% or 12%, okay? If it does 12%, it has a beta of 1.2. If it does 8%, it has a beta of 0.8. Okay, so basically stocks can be aggressive or defensive depending on the fact that they replicate more or less the performance of the market. So what I'm trying to, I don't know a finance program not presenting that model to students. And RF is the risk-free rate. So basically you're saying performance of any stock is a risk-free rate plus beta times the performance of the market on top of the risk-free rate plus something that is coming from something else in the market. Okay, so basically you have three portions: risk-free rate, your risk-taking, that what could be rewarding you, and another source of risk. Okay, you have two sources of risk in this model: the risk on the market portfolio and the risk on the idiosyncratic risk. Okay. So that's the way you pitch usually this model, and they say, and normally your professor at this point says there are two different types of risk, one called systematic, one called idiosyncratic, and when I'm combining many stocks together, okay, I'm going to average that component, and then average that component, and as I am averaging this component, it will go away. This risk is called diversifiable, and this risk is called underdiversifiable, the other one. And you should never be rewarded for that. You will only be rewarded for that. Normally, you should ring some bell, but maybe at this hour of the day, a bit less so. The story I'd like to tell today is a bit different. Another typical exercise that professors ask you to do usually is to run a simulation. Okay, look at the volatility of a portfolio. Okay. When you're increasing the number of stocks in your portfolio. Okay. You can compose a portfolio with 5 stocks, look at its volatility, or a portfolio with 10 stocks, 20 stocks, 30 stocks, 100 stocks, and look at the volatility of the portfolio. And there is always the pattern which goes like that. Initially, you have a large volatility, and then as you're including new stocks in your portfolio, the risk of your portfolio goes down. But it goes down until a level that seems to be impossible to beat. What's happening is you're eliminating that risk. Say risk of I is risk 1 plus risk 2. When you will be combining stocks together, risk 2 will evaporate. And the only thing that will remain is this risk, because it is always the same source of risk. Each of these epsilon I are unique, right? What's happening at Pfizer is not happening at Netflix. What's happening at Netflix is not happening in Total. but they're all connected to their underlying market. So when you're combining them together, what you're losing on Netflix specific story, you will make it on Pfizer's specific story, okay? So things will cancel each other. Eventually, what will remain is only this thing. Therefore, you will be exposed to that risk whether you want it or not, as you will be increasing the number of stocks in your portfolio. But that's not the point. I think one of the most important lesson in the diversification and the CAPM is usually not really, I mean, at least to my understanding, not really well presented. Something else is happening, and that's exactly what's on the graph on the right. The graph on the right does exactly the same: increase the number of stocks in your portfolio, and look at the explanatory power of the US GDP. So US growth, okay? The US growth impact on your portfolio. And as you can see, as you're increasing the number of stocks, you're also increasing your exposure to something that is common to every stock, which is the world growth situation. 5% may look low in terms of explanatory power. These things mean 5% of your performance is explained by the US GDP. Okay, it's low, but is it really that low? Basically, stocks are very volatile. The US GDP is not very volatile. One is quarterly, the other is daily, or daily, even intraday, up to the second. So that basically means that there is something that connects all of these stocks together. You can say it's a market portfolio, or you can start thinking like what drives the market portfolio. And what drives the market portfolio is maybe the economic situation. Okay? And that's where I would like that's a journey I'd like to take with you. Oh, 30 minutes. So basically, that's just a summary of the different elements. So as the number of assets in your portfolio increases, the volatility of your portfolio decreases. That's pretty clear. The discount decreases the limit. There is an asymptote that makes that you can't beat, basically. There is a risk that you can beat, and that risk is a systematic risk. And there is no way you can avoid being confronted with that risk. But in the meantime, you're growing an exposure to something else. So you're getting rid of a risk. It's the risk of Pfizer, the risk of Netflix, but you're onboarding another type of risk. And if you fail to understand this new type of risk that you're onboarding by doing so, basically you will be struggling understanding why you're making money. Another model. I'm also hoping that you've been introduced to Gordon and Shapiro, and there are many ways of expanding on that and doing new models and stuff and stochastic and whatever. Some people in the audience won't be able to say the opposite. But they've been creating a stock valuation model that is a very common way of thinking of stocks. If you've had a corporate finance class, you know that the price of a stocks usually is the infinite sum of all the dividends. Present value of all the dividends. Should be ringing some bell at some point. So basically the idea is to say the price of a stock, okay, is the sum of the next dividend taken in present value. You can disregard the 1 plus R, basically. It's not really, that's not the cornerstone of the thing. Plus a second dividend for the year after, plus in n years time, you will have another dividend, plus basically it goes to the infinity. And the idea is to say, well, basically the price of a stock is nothing but the sum of all the future cash flow I'm going to get. Okay? The future cash flow I'm going to get when I'm buying a stock is the stream of dividends. Okay? The stream of expected dividends, because these are dividends in the future. Okay? So the price of the asset, and that works for all assets basically, is nothing but the sum of the present value of all the future cash flow you're going to get buying that asset. It works for bonds. You will get coupons, which are normally certain. It works for equities, where you're going to get dividends. And that sum is infinite. And there is the mathematical twists that makes that when you say that dividends are growing by a growth rate of J, okay? You assume that J is the growth rate, the constant growth rate of dividend. Okay? The company will be serving you 2% more dividend every year. Okay? You can solve the model and find out that finally that big expression can be reduced to next dividend, not the current one, but the next dividend divided by J minus R. R is this little rate here, J is the growth rate of the dividends. Okay? You can see that with your eyes of corporate finance guys and say basically J is the growth rate of dividend. It's a parameter that I'm going to get from the company. I'm going to look in the books of the company and try to understand how they distribute their money, right? They do earnings, and then a slice of the earnings goes to the stockholders. The rest will go as reserves, okay? And R will be the rate that resembles that balances the underlying risk of the company. Okay? It's called the WACC, the weighted average cost of capital. It's an interest rate that reflects the level of risk that the company represents. How leveraged is the company? How likely is the company to be generating revenues? How volatile are the revenues? Whatever. So once more, usually when you're a corporate finance, that model is presented, and then you're told either there are two versions. The first version is that version, and you have another version that says we can expect the first 10 dividends, and then there is a residual value that you bring back to today's value through a discount rate, blah, blah, blah. But actually, the essence of the model is not there. The essence of the model is the fact that you've replaced a complicated corporate finance equations, right, by two economic concepts. One is at which rates can dividend grow, and what's interest rates, which is something that you've heard a lot of. I mean, interest rates, when I was your age, nobody talked about interest rates. Nobody in the press was saying like the Fed has been manipulating rates to lower the end part of the curve, no quantitative easing, only the short-term rate, but even short-term rate was not something that people were very fond of discussing about. People are talking about economic growth, big dividends and stuff like that, okay? Because the growth rate of the economy was very different. But anyway, long story short, R and G here are two very economic parameters. Let me show you why. That chart is the opposite of a good pedagogic chart. You need to read it from the bottom to the top, okay? At the bottom, you have the fluctuation of the S&P 500. Okay, from 1950 something, 45, I think, until 2020. Okay, above, on the same time period, you have the evolution of U.S. corporate profits. Okay, profits, not turnover, profits. Okay, the difference between how much money you earn and what are your costs. Okay? And the last element is the U.S. gross domestic product. And then you have these gray areas. You have any idea what they are? They are what?
Downturn in economics. It's recessions, depression.
Exactly. Recessions. Periods of recessions. As dated by the NBER, there is in the US we have the luxury of having an entity, a public entity that defines when the economy is in contraction and when the economy is in expansion, which is great because then you can do experiments with using those numbers. Okay. What's striking is every downturn, the S&P goes down. Okay. But also during that period, profits are always contracting. You can look at it whatever way. Sometimes they contract a little in advance, but overall, during at some point during periods of recession, you get a profit contraction. Okay, so every company on average in the US, instead of having like $100 of profits, they get $95 of profits. Okay, which means that they can't distribute as much dividend as before. Why is that? Basically because the GDP, the gross domestic product, how much value added is created by one economy in 1 year, currently $20 trillion in the US, is fluctuating. Okay? The economy fluctuates, which means that profits are fluctuating, which means that the S&P itself is fluctuating. Why is it fluctuating? It fluctuates because basically J is not constant. J varies. So if you want to assess whether stocks are expensive or cheap now, basically you need to be able to assess how J will behave in the next year or so. So your question from before. Currently, stocks, if you remember, are very high. So that question of valuation is a question. When you reach a level like that, okay? It's very high, right? Basically, we've reached a level on the S&P that we never thought we would reach in a year time. But in the meantime, the US Europe, and partially China, have been spending so much money to sustain, to support the economic activity, right? That you could expect, basically we've been eating 10% of growth last year. 10% of future growth, right? That we have imported today, okay? It was unsure in the future and it became certain in just a couple months, basically, okay? And not all of that money has been spent for the time being. There is $2 trillion sitting in deposits in the US, for example, across banks. It's massive. The moment that money will hit the economy, who can predict where the profits are going to go, okay? So these models that usually are presented in a way to say you open your Excel spreadsheet and then you compute out your dividend stream and your discount rate and you compute the price of the stock. It's very interesting, but it's even more interesting than you think. It's even more interesting than you think because basically in that model there are parameters that are heavily related to the economy itself. The second parameter, which we have not discussed yet, is rates. Interest rates are. It's all my energy. Oh, thanks, Amateur. You're right, it's all my energy. You should always profit my slides. Jokes aside, on page 24, even that interest rates is heavily macro. It's the gathering of a lot of macro information. Basically, you'll find in it the government rate, the interest rate on government bonds, plus a premium, and that premium is called the spread, and that spread materializes how risky you are. What does it mean? Again, same chart. I took that straight from the St. Louis Fed data set, and you have data that goes back to 1995, so 1994, I think. The dashed period, the gray bars are the US recession again, and you see that this S goes up every time you enter into a recession. Every time you enter into a recession, companies are less able to generate profits, which means that their risk, right, of not repaying their debt is increasing. So you ask for a premium against that, and that's a macro heavy parameter. I mean, anecdotally, when you see what happened last time that we had a shock, which was March 2020, the rise in spreads has been very limited. Do you know why? Do you have any idea why? But at this moment, we had a new player on the market called the central bank. The ECB and the Fed decided on massive programs to be buying bonds on these companies, containing the increase in the spread. Without that, I mean, in 2008, we saw like 6% of spread for, I think, BBB companies. So basically, if you would want to borrow money as a company, from that moment to that moment, you need to add basically 5% more on top of the interest rates that would be associated to your loan. It's massive, right? If you have a growth rate of the company of 5%, basically it's absorbing everything. So it's killing the company. Okay. So there is a snowball effect. I would say a natural snowball effect that would destroy completely. That could destroy completely the market. Completely destroy the market to some extent. Well. One more stream of macro things, and then I leave you alone. So if you remember well, there were R and there were J. Okay, J, growth rate of dividends, more or less what's happening on the economy. We could argue usually companies are absorbing a part of the shock. Usually when there is a recession, the company are distributing a larger amount of their earnings. So they are making less, but they are distributing more to avoid deep fluctuation on the market. Okay. It's called the payout ratio, and that's a known fact. Spreads, very much connected to macro conditions. When things are going back, basically, if you don't have a job, nobody will lend you money at a low rate, right? If you're making crazy amount of money, everybody will be very happy to lending you money as long as you don't have a reputation not to repay your debt. Now, last element is RGov. So the interest rates associated to government debt. You have different theories around that. Normally, maybe the first one you've never heard of, but the second one maybe you've heard of. The first one is Irving-Fisher rates decomposition. Okay, is famous economist. Okay, yeah, my age he was a famous economist. Not that I am born in that time, but basically in every economics program, you had this decomposition put forward. Nominal yields. So what you guys would call interest rates, people call that nominal yields. Okay. And they can be decomposed into two different elements. An inflation premium, some compensation for inflation, and real yields. Okay. Basically, if inflation is 0, you're earning real yields. As simple as that. Okay. Now, if inflation is 2%, you're earning 2% plus real yields. Okay. I'm going a bit fast here, and that's not exactly the way it works, but the yield at which a government is borrowing money is made of two different elements. The first element is real yield, and the second one is a premium that compensates for inflation. For some reason, when there is a massive wave of inflation, the value of your debt goes down to some extent. So whatever, inflation is an important element. So this RGov stands a very good chance of being a combination of two very economic elements. Inflation premium relates to inflation, real yields relates to interest rates, to GDP growth, to some extent. What I'd like to just emphasize now is what's called the Taylor rule. Maybe if at some point you enter into a marketplace, if you go to a manager or a hedge fund, the concept of Taylor rules is quite well mastered usually on trading flows. So John Taylor in 1993 is an American economist. He formulates some kind of a prediction that the short-term interest rates, so rates to lend money 1 day, 2 days, 3 days, 5 days, depending on the market you're on, can be decomposed into different elements, into 3 elements. A natural rate, without precising exactly what natural rate means. Some alpha times the difference between inflation and some inflation target. And beta times economic growth. Again, I'm simplifying a little bit this equation, but there's a bit of that. Before I explain everything, let me just show you some charts. Here you have the short rates I was mentioning, so that little decision rate, okay? The short rate here is in red, and you have the US inflation next to it. Okay. So basically, high inflation, high rates, low inflation, lower rates. I think the connection is quite clear, okay? Just visually the connection is clear. Why is there a connection? That's another story. Next, US growth versus target rate. There are periods with low growth and high rates. Well, why? We don't know. And periods with higher economic activity and higher rates in the meantime, okay? So let's say that at the beginning, maybe inflation was playing a bigger role, and then eventually growth was playing a bigger role, okay? Clear? It's not a very complicated idea, but it's very fundamental. Basically, it says that when the central bank decides on rates, okay, the central bank decides on short-term rates. It's called decision rates. It's called the target rate in the case of the US, the minimum financing rate in the case of Europe, blah, blah, blah. On the back of her mind, if she can be a person, she would have a natural rate, some kind of interest rates, long-term level, if there is inflation in line with target and no economic growth. Economic growth at 0. Okay, that would be this natural rate. And then the second mandate of the central bank is to fight for a stable evolution of prices. That means inflation in line with its targets. Most central banks today are fighting First, they've been fighting for increasing inflation because inflation was too low. And these days, if you're following the news, basically they are wondering whether they should be fighting against inflation because inflation is too high. It's reached 5% in the US. And the big question is this inflation transient? Is it a temporary phenomenon or is it something that will be longer lasting? Okay. Well, anyway, not the matter for today, but basically the mandate of the Fed, the mandate of the ECB, the mandate of the SNB is to try to make sure that inflation remains quite stable. We hate having negative price evolution. It means that you're in a very complicated situation economically speaking, so you don't want that. And very high inflation is also very problematic. We've had that during the Weimar Republic in Germany. We've had that also in some African countries, in Venezuela. So you know that too much inflation is a problem, not enough is a problem. So you want your inflation to be just on the line. And every central bank around the planet is trying to manage that inflation internally and find economic growth because current economic growth is future inflation. Okay, so you can actually disregard this. Anyway, so what I'm trying to convince you of is that first, when you look at diversification, when you're thinking of the CAPM, the lesson you're remembering is probably there is a good risk and bad risk. There is risk that I can diversify away and another type of risk. But actually what you should be thinking is when I'm diversifying this diversifiable risk, basically I'm exposing myself to something else. That something else is economic growth. It stands a good chance to be economic growth. When you think of the Gordon and Shapiro model or any stock valuation model, in that model, you will always find the dynamics of dividend and interest rates. The dynamics of dividend, that's the growth rate of the economy. It can be much bigger for the longer run. It's not a possibility. Okay? You can squeeze your workers as much as you want to gain in margins, but there will be a moment that this thing will end up bad. Okay? And R is the basically most economic element in financial markets because it relates to economic to monetary policy and even more today. Okay? Central banks around the planet, instead of controlling only the short end of the curve, if you know what an interest rate curve is, are started to control also the longer end of the curve. And basically, interest rates have become like an instrument for the monetary policy all across the curve. Okay. Well, so basically, the idea is more to say, go back to your question. If you want to be able to anticipate financial markets, you need to understand its connection to the economic cycle. Okay? And that's not something that I've uncovered, right? It's something that many people progressively through the past 10 to 20 years, 10 years max, have been more and more uncovering. So basically, empirical analysis showing that there is cyclicality in the performance of assets, that these cycles are actually well connected with what's happening on the economic front. There is a very, I'm going to show you an exhibit from that paper by Ilmanen in 2014, but basically he and his co-authors are showing that there are macro sensitivities to equities, to interest rates. And you know what? This guy used to be working. At some point, he's been in the academia, I think. But eventually, he went to working for one of the biggest asset management company in the planet called AQR, which is an American asset manager managing about 100 billion US dollar, which is quite significant. So it's not like it's academic contributions appearing on the corporate side, so on the side of asset managers, which I find quite striking. And it goes to the front saying you should pay attention to the economic cycle. But he's not saying how you should pay attention to the economic cycle. He's just saying like it's important. You need to watch it. Value and momentum, Asnes. They show that value factors, momentum factor, they have opposite signs on some liquidity signals, but liquidity dries up during bad periods, and bad periods are coming from recession to some extent. Blitz and Van Viet, they come from Robeco, which is a Rotterdam-based asset manager, a quant asset manager, very big shop, very respectable shop. And in 2009, they came up with a 4-regime economic cycle and showed that during each of the 4 regimes, you have different types of performance of financial markets. More recently, with my former boss, Jérôme Telech, in 2021 at Unigestion, when I was working there, we also showed that there are alternative quant strategies, risk-neutral, market-neutral quant strategies that have regime patterns. And you can see that you think that you're diversifying your risk, but actually the market-neutral strategies you're onboarding, they are actually also quite related to the economic cycle. So there's one exhibit which I find interesting. That's from the Ilmanen paper. I mean, that chart is very, very well known in the industry, I think. It shows the Sharpe ratio of global equities, global bonds, commodities, value, and momentum factor during different economic conditions. Growth up, expansion, growth down, recession, inflation up, rising inflation, and inflation down, declining inflation. So without a lot of surprise, equities have a near 0 Sharpe ratio during downturns and nearly 1 Sharpe ratio during good periods. So if you're able to forecast when will you have good periods, you should be holding equities, and when you can forecast bad periods, then you should be withdrawing yourself from the market, because that would be quite timely. The opposite happens for bonds. Bonds would have a bigger Sharpe ratio during recessions and a lower Sharpe ratio during good periods, and so on and so forth. Inflation, bonds are suffering during inflation up, but enjoying inflation down for some reason. Again, the connection between bonds and the inflation is usually very tricky. Cats and dogs. Anyway, so even for factors like value and momentum, you also find asymmetries. Okay, you're better off with momentum during good periods, and you're better off with value during bad periods. Also, striking patterns. Basically, that's what we've done with my previous boss, my former boss. Same type of charts, Sharpe ratio during different types of period, recovery, expansion, slowdown, recession, and you can see that we agree with Ilmanen, equity momentum, good performance during expansion, bad performance during recovery. But also during recession. So we've been a bit more granular, but also we've looked not at not at like long only traditional type of investing, but more market neutral, liquid alternative type of investment if it speaks to you, and you see exactly the same type of patterns. I'm gonna just make a pause here. The issue is these type of strategies, you pitch them to your clients by saying you want to help them to diversify their risk. So the idea is to say, I have equities and bonds, okay, and I want to increase my diversification because I don't know where the market is going. So I would like to onboard things that are lowly correlated to my current portfolio, okay. As one of my friends used to say, you want to do that when things are going bad, not when things are going okay. Diversifying the rise of stocks is not important. It's not interesting. You want to diversify when stocks are going down. Okay. So usually bonds and stocks, they have a negative correlation. They've been having a negative correlation for some time, and you're looking for other alternatives that will help you enforce this diversification. Okay. But the issue is that when it happens, it needs to happen when market is going down, not when market is going up. So when you see that you have sensitivities like that, it can mean, to some extent, that some of the things you think will be diversifying your investments is not really working. Say volatility carry. You may expect volatility to be bringing you diversification, but during recessions, it brings you negative performance. That's not what you want. That's just adding more equities to your portfolio. FX carry, during recession periods, it has a negative performance. Is that what you want? No. You want to find elements that will support your performance during bad periods. That could be equity value, historically that would have been, not that could be, that would have been equity value. That could be equity quality, which would make sense, equity low risk, again, the global anomaly, or Forex value, which is an interesting strategy on Forex. But you see, it's important to master, even if you don't believe in this macro market relationship, it's probably a better way to be looking at your portfolios because it will help you understand, am I really achieving what I think I'm achieving? Again, think of commodities. 08, 07, 08, people pushing commodities into investors' portfolio, saying that will be a source of diversification. Unfortunately, commodity collapsed during the great financial crisis, just like equity collapsed. So is that really a good way of diversifying your risk, adding more of downward risk during bad periods? I don't have the answer. So just to close it down before we go back to a short Q&A session, but the idea, the route we've done so far in 1 hour and a half is we started with this idea of if I'm taking more risk, I should be rewarded. Moving to how risk is evolving and what is actually this risk connected? Is it connected to luck, to the amount of risks, the vol of your underlying investment, or to something more fundamental? Okay, and that's the fundamental thing is likely to be economic conditions in a broad sense. Okay, broadly speaking, there is good risk to be taken. Okay, but that good risk you're taking is not a risk you're taking like by throwing dices and hoping for a double six. Okay. You're actually investing in the economy. So if you're actually buying stocks which are part of this economic revolution that we anticipate, the green revolution, for example, that we anticipate, maybe in 20 years' time, these stocks will be outperforming the rest of everything because there are strong economic fundamentals behind them. Okay, not just because you've been lucky with double six. That's where I'm trying to go. So the idea is like, being successful in the market, at least that's my take on it. It only reflects my opinion, okay? Over the long run, without relying on an anomaly. It's very important, okay? Because you can exploit some anomalies, okay, in markets. There are behavioral patterns that you can use. There are, say, market dislocation you can exploit and stuff. But for me, it means to being good at forecasting the economy. If you're good at forecasting the economy, if you're good at anticipating what's coming next, then you stand a chance of being able to generate some performance on the market. And that basically moves the focus from how do I forecast markets to how do I forecast the economy. I haven't sold anything, okay? But I've just tried to helping you understand why are so many people watching the Fed, so many people watching government and their policies, so many people watching the GDP evolution of the world. So the final question, of course, for you is, how can I do that? And basically that's for you to find out. And that, in my experience, takes a lifetime, and even lifetime is probably not enough because you need as many experiences of a recession as you can find. And with my past, say, 17 years, I've seen 2008, 2015, 2011 in Europe, the slowdown of 2018, and what's been happening in 2020. And every time it's different, and every time you get it wrong. But you're learning progressively as time goes by. Anyway, that's pretty much it for me. And now it's time for a couple of questions. If you have some, if not, we'll be early by 5 minutes, which really something you guys appreciate.
Could you explain the concept of credit swaps once more?
Credit spreads.
Yeah, and why the central banks, what was their impact?
Yeah. So the idea is to say, when you're a company, when you're a corporate, okay, you're borrowing money from the market. You're issuing bonds. A bond is a portion of your debt. And you're pushing that to the market, and I, the investor, will lend you that money by buying that bond. And that bonds come with an interest rate that you will pay to me, okay, called the coupon. And that coupon fluctuates depending on the moment you're issuing the debt, okay? That coupon is a function of two things, the interest rates that the interest rates of the government bonds, of an equivalent government bond. Okay. Say that you're issuing debt for 5 years. Okay. You look at what the US Treasury pays for 5 years, and then I'm gonna think of a premium I want on top, given the risk that you represent. I don't really know you, right? So I'm not sure that you will repay your debt. So I'm gonna try to hedge myself and ask you maybe 2% more. Okay. That's called the credit spreads. Okay. And that spread is reflective of the confidence I have in you. Okay. Now, if I take all of you, it's not a question of if I trust you, it's a question of collectively, are you doing okay? Okay. And when you're entering into a period of recession, collectively, you're not doing okay. Okay. I've seen cohorts of students from masters, finance masters entering the job market in 2008, for example. Okay. You are not doing okay. It was difficult to find a job back then for you guys. These days, it's easier. So you're doing okay. So I'm going to ask for some spread, but not too much spread. Okay? But when collectively we all go bad, everybody's going to ask you for an increased premium. So the interest rate, instead of being 3%, I'm going to ask you for 10%. So that to be sure that I'm going to make it's a good deal for me. It remains a good deal for me. Okay. Now, so as you can see, usually during periods of recession, spreads are going up. And the last recession, spreads increased and then stopped increasing. Central bank put together, say, buying programs. Okay, they've been buying bonds, corporate bonds, until the moment the market was convinced. Until the moment they've been buying bonds like crazy. Okay, to compress the spreads. Basically, if you buy bonds, their price go up, and their interest rates go down. So the more they buy, the higher the price of bonds, and the lower the interest rates. Therefore, the more compressed the spread. Okay, and they've been unleashing massive buying programs around the globe, in the US notably, and in Europe. And the ECB is buying corporate bonds. And they are programs to prevent spreads to reach levels that would create snowball effects. The first mandate of a central bank is not to fight against inflation. You know the role of central bank, you know what it is? The first role of central bank is to be the guarantee of the functioning, of the normal functioning of the financial stability, if you like, of the financing system. And that's something that people usually tend to forget about. When Mario Draghi arrived at the ECB, people are saying like he will never be able to twist the arm of the German until to be able to buy bonds and to lower rates and lower spreads. But actually, you just need to invoke the fact that your mandate is to protect the normal functioning of financial markets. I have a question here, and I think then just on time. So I'm going to read the question from Mathievich, which I totally don't know. Are pure macroeconomics still driving markets today, knowing that central banks have heavily entered the game? Do you think that we've switched to an environment where mostly central banks are driving the market instead of pure macro data, and then the macro models patterns and past returns are not accurate anymore? It's a very good question. It's not the more good question. So I mean, 2 short answers, and Mathieu, I strongly encourage you to send me a message so that we can have beer and finish the discussion. But the idea is there are 2 things that come to my mind. The first thing is that when I started working as an economist, there was a group of people following, notably Mohamed El-Erian, which is a famous economist in the city, in the industry, saying that you should always listen to the Fed. If you want to make money, listen to the Fed. And that's something that I've heard in 2007, 2006, which means basically that people saying that the Fed is twisting everything it's an idea that has been with us for a long time period already. Okay, so it's not something new. And next, yes, true, the central bank is intervening a lot. The central banks are intervening a lot in the market, but They are not intervening when everything goes right, okay, goes okay. So basically, when rates are going down, true, that's a reflection of what central bank are doing, but they are doing it because something bad was happening. At least that is my understanding, and we can argue around that. So there is temptation, and as you know, Mathieu, I've been running some strategies based on systematic relationship between assets and macro conditions, and the P&L has been basically actually okay over the past couple of years. The only change was the fact that in 2020 there was a moment when we didn't have the data to measure what was happening in the economy, and that was a very big problem for this kind of model. That's another story. Overall, true, maybe central banks are changing these relationships, but not to the extent of destroying it. At least that is my understanding. Thanks for your question. 1 hour, 29 minutes and 39 seconds. I think can call it a day. I mean, I'm around after that if you'd like to ask a couple of questions more. Martin, how do you see the future of finance, currency, and market economy? Up. No, it's much too broad question. But I mean, that's for you to uncover. Basically, you're the generation. You're the cryptocurrency generation. I'm sure you will find out. You will be faced with something new, and there is always something interesting to be analyzed. It's a great job, really. I mean, portfolio manager, any activity around portfolio management is very interesting. And I'm not saying we've had the discussion today with one of my colleagues, and it's not a matter of money, of course. The wages are high in that industry, but that is not the cornerstone of that industry. It's really interesting because you're in the market, you're following what's happening in terms of monetary policy, in terms of government activity, in terms of trends, in terms of COVID, in terms of everything. And that gives you an overall view of what's happening in the economy. And I don't know, every day is different. And which is, it's quite a quality, I think, when you're looking for a job. Anyway, thank you very much for your attention.